Hi, folks. Adam Taggart, co-founder of Peak Prosperity here. I'm back again this week with the lead partners from New Harbor Financial. That's the financial investment firm that Peak Prosperity officially endorses. I'm joined today, as usual, by Mike Preston. Mike, great to see you.
You too, Adam. Thanks. Nice to see you.
And we're also joined by John Lodra. John, thanks for joining.
Hi again, Adam. How you doing?
I'm doing great, thanks. All right, folks, I've got a bunch of slides I want to get through, and I promise to get through them as quickly as possible here so that we can then get our first question to the guys from New Harbor here. I'm going to start looking at as we have each week, looking at the most recent number of folks who are applied for initial jobless claims. The numbers just came out this morning. 3.8 million additional people have filed for unemployment. That makes it over 30 million people in the past 6 weeks who have joined the ranks of the unemployed. Folks, that is just historically completely without precedent. It is a staggering number. As the chart here shows, it just completely dwarfs anything over the past 40 years and certainly makes the unemployment that we saw during the great financial crisis look like a tiny blip. I just want to reiterate here that the damage that's being done to the American workforce here is not temporary. It is going to take a long time to put those people back to work. We launched a survey on Peak Prosperity earlier today where we had interviewed several thousand people in America, which included a bunch of executives at corporations as well as small and medium business owners. And 70% of them, after the coronavirus is over and done with and behind us, estimate that they will hire back fewer people to do the same work as they had previously employed, which is not a good sign. And of course, we still have a number of company bankruptcies and stuff ahead. They tend to lag job losses by about 3 to 4 months. So that's all additional fodder to say the damage that's being done now is long term. All right, switching from these unemployment numbers and just looking at GDP, we finally have gotten the first data here that shows how the US economy is empirically being impacted by the coronavirus. And it certainly is. You're seeing here that Q1 GDP down negative 4.8% over the past 30 years. That is the second worst quarter in terms of GDP contraction that we've seen. There was only one quarter in the great financial crisis that exceeded that. But as concerning as that is, and that is a painful number, look here at the chart at the estimate for Q2 2020, negative 27.7. And of course, folks, that's still an estimate. It doesn't mean it's going to be accurate, but it could also be even worse than that. So this is just showing that we have a summer of pain ahead of us at least. And who knows what the Q3 numbers are going to be like. Referencing the survey again that I just mentioned earlier, the projected outlook from the business owners that we talk to, business owners and managers, again, it's just projections, but they project things getting worse throughout 2020, and they don't see any sort of beginning of a recovery to their business's profitability until mid-2021 at the earliest. So again, we really need to be preparing here, not just for a V-shaped recovery, but for something that's going to be much more prolonged than that. You begin to see the impact of this in data that's a little bit more slow to move. Here's the chart of US pending home sales. You'll see here how the index has basically dropped by almost 20% from February to March. And of course, things are going to continue to get worse. April's numbers are sure to be worse than this. And there's a whole bunch of other factors that are likely to put additional downward pressure on housing. So point here is we're beginning to see the manifestation of the damage, and we are probably in inning one of this. All right, so that's on the bad side. Now, of course, this chart shows the increase in the Federal Reserve's balance sheet in just the past month and a half. A staggering number. Again, folks, we're just continue to remain in historically unprecedented territory here. $2.26 trillion in just 6 weeks. That's what the Fed has done by increasing its balance sheet, which is another way of saying I'm pushing money out into the economy. Is that going to be enough? That's a huge question. A lot of debate going on. We're going to debate a little bit of that here in today's conversation, I'm sure. But I just want to let folks know the magnitude of what's going on here. It took the entire 100-year history of the Fed to get to 800 billion. That was right before the great financial crisis. Since then, the Fed increased its balance sheet to a little over 4 trillion. It tried to tighten a little bit. The market didn't like that. And of course, now that COVID is here on the scene, that attempt at discipline has just been tossed out the window, and the Fed is now doing whatever it takes. It just reaffirmed that yesterday. And then, of course, you're seeing trillions every couple of weeks here. Where this chart stops, who knows, but certainly a sign of future liquidity to come. And that is being reflected in the markets. I'm putting up a slide here of Tesla, really just as a poster child for what I'm going to call the insanity that we're seeing here in the markets. The guys at New Harbor might have a different opinion, but Tesla had hit ridiculously hard to justify valuations back in mid-February. They got hit along with the rest of the market, but as you'll see, things bottomed out there in May, and it's been a rocket ride ever since, including after they reported earnings yesterday. You'll see circled in green here, Tesla was up like another 10% in the aftermarket. Now, this is a company, mind you, that still is burning through cash. It is barely profitable on a cash flow base, barely profitable on a GAAP earnings basis. And on a cash flow basis, as you can see here, not only does it have a long history of losing money, but it is continuing to do so in this latest quarter. And of course, given the impact now of coronavirus on the global economy and the huge drop in people that are going to be able to afford its cars and whatnot, it is likely to be burning cash for a lot longer. But hey, don't tell that to the market, because Tesla's back close to all-time highs. Have a similar situation here with Facebook, similar trajectory to the stock, where it was at all-time highs right before the coronavirus came onto the scene. It crashed along with the general market. It's recovered very nicely since, and then you'll see, just like Tesla, Facebook also reported yesterday, and its stock was up 10% in the aftermarket. Now, this is a company that makes just about 100% of its revenues. I think it's like 98% of its revenues from advertising. And just here are some headlines about what's happening in the advertising industry. Publishers and ad tech companies predict their digital ad revenues will be down an average of 19 to 25% in the March through June timeframe, right? So that's about a fifth to a quarter of the advertising market vaporizing. This survey builds on an earlier one of 400 media planners, buyers, brands responsible for US ad spend, and found that 74% believe the coronavirus will have a greater impact on ad spend in the country than the 2008-2009 financial crisis. And folks, back then I was working at Yahoo, and I saw firsthand how quickly advertising dollars evaporated as we began entering the recession. I can guarantee you the same thing is going on here. In fact, Facebook even mentioned that on its earnings call yesterday, that it had seen a pronounced slowdown and drop-off in advertising in April, and it refused to give forward guidance, as did Tesla, saying that there's so much uncertainty it would be irresponsible to speculate. Again, don't tell that to the market. It drove Facebook shares up 10% higher after they made that statement in their earnings release. But that's the market that we find ourselves in today. Guys, looking at where we are, seeing this huge disconnect between the increasing mountain of bad data that's coming in as we begin to get better and better clarity on how much the coronavirus is damaging and punishing markets. Not markets, but the global economy. Looking at all the people who are losing their jobs and going to have a really tough time going back to work. And looking at these companies that are clearly going to be seeing lower demand from their customer base going forward, impaired ability to afford their products, in the case of Tesla. And yet the stock market has recovered dramatically from the lows of late March, early April. And some of these companies, especially the big FANG tech complex, back near all-time highs. I gotta say, it's crazy making, to be honest. I had an awful lot of criticism to be able to make of these very high valuations back in mid-February. And back then the narrative was, look, everything's going to be great going forward from here. I have an incredibly hard time seeing these companies back near those same valuations, but understanding that some huge percent of the global economy has just gone away for a prolonged period of time. Is that 20%? Is that a quarter? Is that a third? More? We don't know. We're still watching as the dust settles here. And of course, nobody knows how long the coronavirus is going to be around for. How long will these lockdowns last? Once they're lifted, will that be it? Or will we have to have this sort of rolling sequence of lockdowns as we let people go out, people get reinfected, and we have to tighten things back down again? So my question for you, New Harbor geniuses, is are you looking at this the same way that I am? Or do you see a rationalization here that I'm just missing in today's market valuations?
Adam, I think, no, we see things exactly the same way. I think it all comes back to the reality that we're in a bubble. Bubbles, by their very nature, are irrational. I think anybody alive or with a memory of the tech bubble or the housing bubble can look back objectively and say, it didn't feel like it then, but man, was that irrational. And that's what happens in bubbles. Things that make no sense happen, largely because they're largely driven by psychological motivations, not real fundamental or logical or rational calculus. So yeah, I mean, we see it exactly the way you do. The earnings of companies has plummeted. Most companies that have reported earnings have yanked any kind of forward guidance whatsoever, which basically just speaks to the fact they can't see beyond today, never mind next quarter, in terms of what their earnings or profitability are likely to be. Even just looking at last year, 2019, the S&P 500 was up about 30%. Almost all of that gain had to do not with increasing earnings, but an increasing earnings multiple expansion, as it's called. So if in fact, if one wants to take the view that the market always looks ahead, well, last year, the market was looking ahead quite apparently at, some fantastical earnings picture, which clearly hasn't happened. So way beyond logical explanation at this point.
Yeah, and that's, I think, what really just drives me nuts here is that was the rationale being given 2 months ago, or maybe 2.5 months ago now, for the crazy valuations these stock prices were at. It was that, hey, the future's bright and it's only getting brighter, right? And that's what we're being valued on here. Now, 2 months later, they're at similar valuation, except the future is incredibly darkened at this point in time. So, it's just, even though I didn't believe it 2 months ago, it was more believable than it is now. Mm-hmm. So, Mike, I know you and I have talked a little bit about investor psychology here, and also about technical analysis and Elliott wave analysis, which many viewers here may not really know what that is. But in bear markets, what tends to happen is you have the initial drop that catches the bulls by surprise, and that does mark the reversal. Then you have a recovery, what's called a bear market rally. These are often quite sudden recoveries. They tend to sort of have a V bottom. And psychologically, I think they give the bulls some false hope, right? Like, oh, actually, maybe it's not a new bear market that's starting. Maybe this was just a brief correction and we'll be back to the all-time highs. And then that fails, and then the next down leg that comes tends to be the one where the majority of the bear market drop happens in. Is that how you're looking at the market right now? Not asking you necessarily to say that, hey, it's exactly what's going on, but is that how you're looking at the market right now?
Yeah, indeed it is, Adam. And this has been tough to watch the last couple of months with everything that's been going on. We, of course, had a bubble high on February 19th that really started back in mid-September when the Fed started quantitative easing, what they called not QE. And that was just a blow off top on top of blow off top on top of, other blow-off tops that have happened the last couple of years. And that one brought us to the ultimate high of 3,400 or so in the S&P. And then we had the fastest drop really in history, even a little faster than the initial drop from the 1929 Great Depression peak. And right after that, we had one of the fastest recoveries. So it was fast down, about 30% down and almost 30% up. And of course, the way the market works, if you drop 30% and you go up 30%, you're still down a little bit. But, it was something like 26 trading days down. And ironically, through yesterday's close, it was 26 trading days up. It feels like months or years. It feels like a lot longer than that, but it was very quick, very swift. And, the job of this rally off of the March 23rd low is to convince everyone that everything's back to normal, that this isn't a bear market, that they have to jump in. What the Fed is essentially trying to do is get people to feel like that they're missing out. And so the FOMO, or fear of missing out, happens. And so, we've got a chart, and you'll probably be showing that. The chart is a pretty classic chart that's pretty well known. And, it takes a look at the full market cycle. And, where we are from that top is in the return to normal phase. It's that first major retracement. That first retracement, or the wave 2 retracement, wave 1 down, wave 2 retracement up, is usually the fastest and swiftest of all of the moves in any market cycle. And it indeed convinces people that they have to get back in. And that's what we think we're seeing right now. We've seen about a 5/8 retracement on the S&P, 62%, which is a pretty common relationship, a Fibonacci relationship. The NASDAQ has bounced even higher. And even though you said it's essentially at all-time highs, it's not quite there. It's about 70-something percent. These are very deep retracements. And it is tough to watch it day to day and week to week, particularly when you're sitting out and knowing that this is probably the beginning of a bear market. But indeed, we think this is the beginning of a bear market that's likely to drop more than 50%, maybe 60 or 70% from its high, and will likely unfold over the next 1 to 2 years. So we're tactically taking advantage of drops, but the time for that was last month. And we're flat the market essentially now, and we're heavily in cash waiting for our opportunity, because the next wave down, if and when it happens, would be the third wave down, which is going to be the swiftest of all of them. And that's the one that would do real damage and create some fear and capitulation, unfortunately, in the marketplace. And we want to steer clear of that.
All right. So just speaking to the chart, I'll keep it up here for a few more seconds. We can see that we were at the peak. If indeed this is the beginning of a new bear market, we've gone through that first dip where we've begun what the chart here labels the bull trap, where the bulls pile back in, and as the market recovers, they feel like, okay, great, we're getting back to normal here. That was just a scare we don't need to pay attention to anymore. And then that complacency quickly evaporates as the markets roll over and the real bear market occurs. So I'm guessing you see us somewhere right up there by the return to normal peak of that second rally. It's just a question now of sort of where are we exactly on that peak? Are we near or at the top, or do we still have further to go?
Timing that exactly is impossible, but if we're right and we roll over again into a new wave down, that wave would be faster and more severe on a percentage basis than the first wave down from the top. So it's a pretty critical point to not be lulled into thinking we're going back to normal. We're, again, extremely defensive here. And, if we have that rollover, we won't be too quick to want to jump in, because we think it's, going to be that steep segment of the graph that you have up.
All right, great. I want to ask one more question on this topic before we move on. So I'm going to put up another couple quick charts here. So first off, here's a chart of the concentration of the top 5 stocks in the S&P 500 index. You'll see here the S&P basically is the most concentrated that it's been in the past 30 years or more. This chart only goes back to 1990. Back in 2000 was the prior peak. That's where we had big players like GE and Microsoft and Cisco in the mix. Now the big players in the S&P are all pretty much big tech, right? Microsoft, Apple, Amazon, Alphabet, Facebook. you can see here we're substantially higher than we were at the peak before the 2008 crisis, which is indicative of not only high concentration, but a high level of vulnerability should something happen to the tech sector. Putting up a chart here just to show this in a different way. This basically shows the market cap of those top 5 stocks versus, I can't remember the exact number, but I want to say maybe like the bottom 420 other companies in the S&P 500. And it just shows you how much they dwarf the other companies that are there in that index. I mean, really the S&P, as go these 5 companies, so goes the S&P. It makes me ask the question, do we have to see a failure in the FANG sector before these markets stumble?
Yeah, so Adam, it's a great question. One thing that a chart like this doesn't speak to, if you look at in 2000, for example, the tech bubble was largely a result of really large cap tech stocks being egregiously overvalued, right? But the reality is there were some parts of the market that weren't so egregiously overvalued. So there were places to hide, so to speak. The different thing about this current episode is that not only do the few largest cap stocks represent a very high percentage of the index, but if you were to look at the valuations of the median stock, John Hussman's done some great work looking at valuations for the market by decile. So not only looking at the top decile, but looking all the way down through and deciles are blocks of 10% chunks. Across the board, all those deciles have recently had higher valuations than any time in history. So whereas prior bubble episodes like the tech bubble, there were some reasonably priced areas of the market, recently the whole market has been egregiously overvalued relative to its own historical norms. And this is largely a result of monetary policies, forcing people into all manner of kind of speculation. And what we've gotten here is expensive stocks across the board. There are very few places to hide. So no, it doesn't necessarily require the FANGs to falter, but it certainly would be textbook behavior for these stocks to start to falter. A couple big FANG stocks reported after hours here, Amazon and Apple, and so far it looks like both those stocks are reversing on earnings here. Apple's shot up, and now it's below where it opened earlier today. So we may be seeing a blow-off phase here in some of these tech stocks. I think you mentioned Tesla reversing its gains earlier. These could be very much blow-off tops in these story stocks.
I'm glad you mentioned that because we did talk about Tesla reversing its gains, but I think we talked about that before we started recording. It's been an incredibly strong several weeks for the tech sector, but particularly these high-flying stocks, and this week was no exception. And I mentioned earlier, what Facebook and Tesla did in their after hours last night, and that was in addition to pretty healthy gains that day and earlier in the week, and certainly over the weeks prior. And really beginning to feel like it was a euphoric, manic blow off. Could be a manic blow off top. And last night, they spiked as highly as they did, but then as the aftermarket went on, they actually came down fairly substantially, and then Tesla actually closed down today, and Facebook was still up, but not nearly as much as it had been the evening before. So it did look sort of like a textbook beginning of a reversal. Still too early to tell, but like you just said, John, we're seeing Amazon and Apple basically disappointing as they've now given their earnings this week, today, and the market's beginning to, it sounds like, go red on those stocks. So probably way too early to tell, but it seems to me that this is some of the stuff that you guys are tracking right now, right? I mean, you're looking to see, are we beginning to see sort of sell the news events in some of these key high flyers, and maybe we are beginning to. And I guess I'll just ask this question once more in a slightly different way. If these stocks begin to roll over, these big story tech stocks, how likely is that to pull the overall market down with it?
Extremely likely, Adam. I mean, once the leaders get taken out in reverse, it's a very foreboding sign for the market. You could sense the euphoria, as you said, over the last few weeks, particularly yesterday after earnings reports. And then, of course, the reversals today are the first sign that something is changing. Generally speaking, you'll see the leaders falter right when a trend changes. So, if that happens, and we might even be seeing it now, who knows? It happens very quickly, then that would be a very loud danger signal for the market.
All right. Okay. Well, speaking of trend changes, just looking at the precious metals here, unlike tech, they've not had a very good week. Do you guys see this as sort of noise right now? Because in previous weekly discussions like this, you guys have made your position on the precious metals pretty clear. I believe, and correct me if I'm putting the wrong words in your mouth, but I think you guys feel like a new bull market is underway in the precious metals. So are we just seeing a little steam coming off, or is this in any way a trend reversal that might be concerning to you?
Yeah, nothing about what's happened this week is at all concerning from a technical trend standpoint. Today is the last day of the month. There certainly can be some profit taking going on in that sector. But the move has been fairly volatile in recent days, but not at all emblematic of a trend change. We do have hedges in place on a good bit of our precious metal exposure for clients that effectively put a downside floor in the downside risk, those positions. But we haven't seen anything concerning, in that sector that would indicate the move higher is over, or we're entering a prolonged move down by any stretch.
Okay, great. Let's see. I'm just trying to think. I know the markets continue to keep you guys on your toes, and I appreciate the time that you give us here. Just looking at the headlines, I've seen that Shell they've stopped their dividend, and I believe it's the first time since World War II that Shell has done that. On last week's video, we talked a bit about what's happening in oil and got your guys' feedback on that. But I found that to be notable and supportive of what we had talked about last week, that the damage that's happening in the energy sector based upon the drop in demand and the huge glut right now caused by some of the supply chain vulnerabilities, especially in oil, where it doesn't take that much of a glut to really impact prices, given the way that oil flows around the world. That I thought was a very notable development. Similarly, right before this, we got on here, I saw that J. Crew is filing for bankruptcy. Retail has been, in a secular decline over the past several years anyways, but the coronavirus is just a massive gut shot to that industry. And I think we're going to see an awful lot of brands that we've known for a long time, go bankrupt and potentially go away over the next year or two as we enter this. Well, clearly, it's going to be a recession. How bad of one? Do we change the R to the D at any point in time? I don't know. But I'm just curious, are there any other headlines like those that have caught your guys' attention, or that you're looking at, particular sectors closely because of, what's happening on a week-by-week basis?
Well, I think the real estate market is one to watch really closely. We're seeing, not surprisingly, a slowdown, pretty dramatic slowdown in pending home sales. Even anecdotal things like, Airbnb, which has become a huge platform for folks to rent their investment properties. Very ominous signs there. Bookings, not surprisingly, have fallen off a cliff. And I just saw an article yesterday on so-called super hosts on Airbnb. Folks that have something like 25 or more properties. Really became a business, and a lot of those businesses were built through levering up. Purchases of real estate, and with the sudden cliff, suddenly carrying the servicing cost of that debt is becoming very problematic. So I think we're going to see some really impactful ripple waves going through, those kinds of markets as a result of what's going on here. And that will have probably broader implications on real estate across the board.
Yeah, I'm glad you mentioned that. I've read that article too. And it was interesting, one, to see how many people were running those businesses at a price to perfection model, because I felt like that was a pretty good parable for how a lot of America works in general. Lever up and just as long as you can make your debt service payments, everything's going to be fine. And that logic works great right up until you get into a crash crunch, right? Cash crunch. I think it's going to be exceptionally destructive for those people. But especially a lot of them can't even rent out their Airbnbs. It's not even an organic drop in demand. It's because of the social distancing regulations. They're not allowed to rent them out. But to your point, John, I can see a lot of those properties being dumped on the market and being dumped on the market, under fire sale conditions. That may be an additional accelerant to real estate that people hadn't really been thinking about. And one thing to remember with real estate, and same is true with stocks, is they're priced at the margin, right? They're priced at what the next person is willing to buy it at. And if you all of a sudden get a bunch of people being forced to dump their properties very quickly, it doesn't take that many sales to push down the overall selling prices of all the houses in the neighborhood. So It will be really interesting to see that going forward. How about you, Mike? Anything else before we hop off here that's been on your radar this week?
I guess one thing I'd say is that after 10 years of ridiculously easy monetary policy, money printing, if you will, there's a lot of corporations out there that are so-called zombies. There's an old saying that many viewers may have heard it, that you don't know who's swimming naked until the tide goes out. And central bank money printing has covered up a lot of marginal companies, corporations that barely would make it by in a normal environment. We've taken out the seasonality of the economic cycle through central bank intervention. And that was working fine until something unexpected happened. Coronavirus came along. Coronavirus isn't really, I don't think, the major economic risk. I think really it's the fact that the economy is on such fragile ground in the first place, and that S&P earnings were already rolling over late last year, and of course COVID-19 came around, and it was the pin that pricked the everything bubble. And so I think that as we move into the summer, the real risk is going to be for seeing an increasing wave of bankruptcies. Central bank money printing can keep things going for so long. However, when people aren't going to work anymore, when they're not going out and interacting with each other, when they're not buying things, then profit margins, which were recently at all-time highs, start to erode. And there's not a lot of backstop for many of these corporations. Their balance sheets are highly levered now. A lot of borrowing happened to buy back shares. And what made me think about this was your comment about dividends. I don't know about that particular company, but dividends will almost certainly start to get cut significantly in the future if these types of problems and bankruptcies happen and that type of thing. There's more pressure in the system. So it's something to watch for, and we're starting to see some signs of it.
All right. Hey, and
Adam, I got one final thought that we talked earlier on about kind of the almost unbelievable rise in the markets against the backdrop that most folks on Main Street can see with their own very eyes. And I just wanted to kind of comment on there's a very real human story here. I mean, there are people that are out of work, concerned about losing jobs, and the data and the signaling that markets have been turned into as everything's okay. Just want to acknowledge that this is real. It's not in your imagination that things are challenging or have the likelihood to be. So that's a real human story. And we have the fortune of being able to talk to people, not just about markets, but about things that matter in their lives. And we don't want to kind of let our kind of objective talking about markets and the economy lose sight of the fact that there's real human stories behind the kind of work we do with people. So we're happy to, talk with folks about how this impacts their personal situation. That's a big part of what we do.
Yeah, well, I appreciate that, John. That's a great demonstration of why we like to refer people over to you guys. I think saying that is helpful for several reasons for people. One, because it does bring this down to what truly matters, which is, hey, how does this impact real families and real people? I also think a lot of people feel the way that we do but probably at times when they're staring at their screen in disbelief at the discrepancy that we were talking about between the economic data and what they're seeing in the markets, boy, it looks like the world is ending from the data. Maybe even personally to me, it feels like it's ending because my hours are getting cut back, my company's suffering, I've been laid off, whatever. But man, I look at the markets, turn on CNBC, and everybody's telling me that, oh my gosh, everything's amazing and it's only going to get better. I think that takes sort of a psychological toll. It's hard probably not to feel like, you're missing something obvious, or that there's a party going on that you're not a part of. And I think being able to talk to somebody like professionals like yourself who can really ground them and say, no, look, you're right to be concerned for all the right reasons. And here's all the evidence that suggests that you don't want to get caught up in the happy news that's being sold to you, because, we know historically and empirically it just can't end well, right? And so you're really kind of keeping people grounded so that whatever the emotion of it is, whether it's fear of missing out or fear of the party passing you by, whatever it is, that tends to make people panic and make emotional decisions with their money that almost invariably the emotional ones are the ones that you tend to regret. Working with somebody like you who can take that out of the picture, help them focus on, look, what really matters to me, and let's come up with a programmatic way to invest for that. You're doing folks a huge favor. So I'm glad you brought that up. All right. So in closing here, we ended up going a little bit longer than I intended, but guys, I appreciate the extra time. As always, as you guys are talking, I will have the URL superimposed on the screen so that if somebody wants to have a conversation with you, they can contact you. They can schedule a time to chat. Just go to greylockpeak.com. There's an extremely quick form, probably take you 10 seconds to fill it out. And the guys from New Harbor will get back to you and arrange a time to talk. Because of our relationship with New Harbor, and we do have a business relationship with them, I want to be clear about that. We have to have that in place to be able to send people along to them in an SEC compliant manner. So that's going to this Greylock Peak URL. If you go there, all the details of the business relationship will be made available to you. The key thing to note is that whether you walked in through their front door or whether you're coming into this website that I'm putting in front of you, you're getting treated exactly the same. It's not affecting the cost or anything like that. As a matter of fact, if you're coming in through us, through this Greylock Peak URL, you're more likely to get more attention from them. But we've worked at a relationship with these guys because we send so many people to them and have over the years that they will sit down and they will talk with anybody that wants to have a free consultation with them. They'll look at your portfolio, they'll answer your questions, they'll hear what your goals are, and they'll give you their best assessment of what you should be focusing on. And if you end up working with them, great. If you don't, that's fine too. I say this at the end of every video. We at Peak Prosperity are impartial whether you work with New Harbor or not. Our advice is that we want you to work with an advisor who takes the risks that we focus on at Peak Prosperity in these videos on our website into account in their investment strategy. So if you have a good advisor who's already does that for you, that's great. But a lot of people come to us because they have trouble finding somebody like that. And if you're one of those people, we highly recommend the guys from New Harbor. We're comfortable putting our brand at risk because of the great job that they've done for the many, many hundreds of people that we've sent their way over the past decade. So with that, guys, thanks again for another week of going through what's going on. As long as the markets keep us on our toes, we will keep doing these. In the interim, I hope you guys stay safe. I hope you're well. Next week, please send me the clothing memo in advance of the video. I did not get the light blue shirt, so I feel like I'm getting out this week. But hopefully next week, we'll be united in our wardrobes.
Hopefully we'll be wearing Hawaiian shirts pretty soon. It'll be nice summery weather for all of us.
All right, great. I grew up in New England. In fact, I was born in Massachusetts, so I don't feel bad telling you guys it's about 86 degrees out here in California right now.
Jealous. It's a little bit cool here, but we're turning the corner. So,
all right, guys. Well, look, thanks so much for being here
Adam.
this week, and we'll see you next week.
Have a good night.
Thanks a lot.